Here are 5 things that helped me generate 24% annual returns over 7 years investing in stocks. And I guarantee that if you use these tips, you will become a better investor. So let's start with the first point. Stay with me until the end of this video because I'll be showing you live proof of my results and you will see how these rules impacted my real portfolio. So the first point is to only invest in simple businesses. It doesn't matter if the business is sexy or not. What I mean with simple is that you must be able to explain this business to a 10-year-old child under 2 minutes. Remember, stocks are companies, not lottery tickets. There is a company behind every stock. If the company is improving, the stock will go up. So before you invest in a stock, it's important to understand the business behind it, understand the products they sell, understand the margins, whether this company is growing or not. Don't just buy because the stock is going up or you like the CEO. Yes, I'm talking about Elon Musk and the fact that a lot of people invest in Tesla just because of its CEO. I see plenty of people making bad investment decisions because they didn't do the research. If you don't understand how a business makes money, stay away. It's a pass. You can look at thousands of other stocks. This is really important. I know this because I made this exact mistake when I started investing in 2018. Let me share my screen and let's look at the performance. These are my stats. I started investing in June. And for my first year of investing, I made a 30% loss because I didn't follow this rule. I invested in complex tech businesses that I didn't understand at all. So it was a costly mistake, but I learned from this mistake and moved on. The second point is to stay away from short-term trends, things that everybody is talking about, like new industries, like electric vehicles, or new technologies, because chasing the latest trends can lead to big losses and it can happen really fast. For example, you can have a new regulation or a new competitor that is coming out of nowhere and is disrupting the whole industry, including your investment. Within a few weeks, a stock that you believed in can totally go in the wrong direction. If you want to take advantage of trends, I would advise to stick with what you know. If you are a software engineer, you are an expert in this industry, you know more about software companies than 99% of people. That's where your edge is. That's what Warren Buffett calls your circle of competence. If you stay inside your circle of competence, you will be fine. In 2019, I applied this method and I only invested in companies that were inside my circle of competence, companies that I knew really well. Let's go back to my broker webpage. If I put 2019, this is completely different. You can see the results, you can see the improvement. And in 2019, I had a gain of 69%. The third point I want to share with you is before to invest, to have a plan and stick with it. For example, in 2020, the COVID crash was brutal. The pandemic stopped the whole world. People were panicking. Stocks were down 30% in 2 weeks. Some stocks lost 40%, 50%, and never recovered. Even the best companies in the world crashed. But I had a plan. And when the market crashed, I was ready. I had already done the analysis of 30 businesses that I knew really well. And for each of these businesses, I had done the valuation. I knew the value of these stocks. So when market crashed, I didn't panic. I didn't sell. I bought more of these stocks at a discount. I could buy stocks at half the price. That's how you make money in the stock market. And it resulted in strong performance for 2020 and 2021. Let me share my screen right now and let's see the results for the year of 2020. You see in March and April 2020, the COVID crash, where every stock crashed 30%, but I didn't sell at this moment. I continued to buy stocks at a discount. And it resulted in a very strong performance for 2020 with a gain of 63%. And if we continue in 2021, I had a gain of 57%. Just because I bought stocks at a good time. I had a plan, and instead of panicking when everything crashed in the market, I bought good stocks at a good price at a good moment. And I held them because I did the analysis before, so I knew the value of these businesses, I knew the value of this stock, and that's how you create a strong stock portfolio. Now you know that to have good gains, you need to invest in simple businesses that you know really well, that are inside your circle of competence, and you have a plan and you want to stick with it. I would add to that a fourth point, which is to only invest in companies with good management. Before you invest in a business, I would recommend to look at management's track record over the past 10 years. Are they competent? Are they honest? Did they make good decisions, good acquisitions, stupid decisions? Do they make decisions for the long-term benefit of shareholders like you, or just for short-term gains? That's important. And you can look at all this public information and find your answer. You can look at the company's annual reports. You can watch interviews from the CEO. You can listen to earnings calls where companies will answer questions from Wall Street analysts. You have plenty of resources to do the due diligence and to see if the management is honest and competent. Also, you want to make sure that the management is aligned with you, the shareholder. You can check the insider ownership. For example, if the CEO owns 10% of the company, you can be sure he wants the stock to go up. It's a win-win situation. They want the stock to go up, you want the stock to go up. So if you are in this situation of investing in a company with a competent management, a honest management, with an alignment of interest, well, when there is a market correction, when there is a market crash, when there is some panic, a great CEO will be in charge of your money. They will not screw up and they will take advantage of this opportunity, this crisis, this market crash to make more money for you, the shareholders, the owners. And this has a significant benefit. It reduces your stress. It allows you to sleep well at night. You don't stress about your stock. You don't have to check the stock price all the time. You can have more enjoyable days, more fulfilling days. It completely improves your quality of life. In 2022, many companies lost 30% of their market value, and the companies with bad management lost even more. Some lost 50%. This was a challenging year with the war in Ukraine, the return of inflation, and the rise in interest rates. When these difficult times occur, you want to be invested in companies with strong management. That's precisely how I outperform the major US index, the S&P 500. In 2022, the S&P lost 18% and I lost 5%. And the last point is maybe the most important one. It's about valuation. Be careful about valuation. Don't pay a high price for a stock. A famous valuation metric is the price-earnings ratio, or PE ratio. You divide the size of the business by the earnings it generates. So if the market value of a business is $100 and it generates $10 of earnings this year, you can say 100 divided by 10, it has a PE ratio of 10. To put that in perspective, over 150 years, the average PE ratio for the S&P 500 has been 15. So you can say if the PE of a stock is lower than 15, the stock is rather cheap. And if the PE ratio is over 15, you can say it's rather expensive. That's not always the case, but that's a good indication to see if the business is rather cheap or rather expensive. High PE ratios often mean high risk. I would say that paying a PE ratio over 30 is very expensive and very risky. You have to be disciplined about the price you're willing to pay, and even for high quality businesses, because buying a good business doesn't mean it will be a good investment. It depends on the price you pay. The prime example of this is Microsoft. That was a wonderful business in 2000. But if you had invested in Microsoft at that time, you would not have made money for 15 years. It was a great business, growing fast, very profitable. It was just that the valuation was extremely expensive with a PE ratio over 80. Extremely expensive. You can buy a beautiful business, monopoly, strong margins, strong results, strong management, but it won't make you any money if you pay a price that is too high. Having a PE ratio over 30, over 50, at this time 80, that's too much. That's just too much. Personally, I only invest in cheap companies and I totally avoid overvalued stocks. So when markets recovered in 2023, I had a very strong gain. That year, I also became a public investor on the eToro platform, where you can see my results. If we log in on eToro right now, you can see that for 2023, I had a gain of 36%. By the way, at the time of this recording, I have over 300 investors that follow my strategy. So I know that this method is working. What about this year? Well, as of today, we are in May, and my performance for 2024 is already 17%. When you see this video, it will have changed, but you get the idea. So if we take my total performance, you can see that I achieved a compounded annual growth rate of 24% over 7 years, much more than the S&P 500 or the Dow Jones. And graphically speaking, it looks like this if you had invested $1,000 with my strategy, or with the S&P 500, or with the Dow Jones. So how did I create this winning strategy? Over the past decade, I've analyzed the best investors in the world. I studied them from my master's degree in finance at EDEC Business School. I've worked in several investment funds managing billions of dollars like Amiral Gestion or Sycomore Asset Management. I had the privilege of working with renowned investor Daniel Gladish and with the author of one of the best investing books, Adam Mead. I've also attended Warren Buffett's annual meetings in Omaha and participated in many investment conferences. I've spent thousands of hours analyzing what works in the investing world, and with all this data, I developed a unique strategy that you will never find elsewhere. The method I use is working, is really simple, and if you want to get similar returns, I have a guide for you. I've already helped many people invest and make money in the stock market. Most of the time, they came to me and they said that they've tried investing on their own, but they didn't make money, they didn't succeed, or they only made 5 or 6% per year, and they wanted better results. What they needed was a process, a method that works, and most importantly, a feedback. That's exactly what I gave them, and now they invest like the best. They generate strong returns, double-digit returns. They have a strong portfolio that will make money while they sleep. If this is also your case and you want some help to improve your investment results, you can book a free call with me. There is a booking page right below this video.